Hello, welcome. Good afternoon, everybody. Thank you for joining us today. We're broadcasting live from Park City, Utah, where I am. I think Brian's in Pennsylvania, and you guys are California?
Yes.
Yeah, somewhere in
Newport
California.
Beach.
Newport Beach. Great. Thank you all for spending some time with us today. We have a lot of folks on. I just want to remind you that while we can see that you're there, you can't physically ask questions in a video way, but we encourage you to ask questions as things go along here and put them in the chat box of the Q&A. We're recording this, so if after you've seen the presentation today, there are others that you think would find this interesting and benefit from learning from our folks here and being in touch, we welcome and encourage that. We're going to make sure that everybody who's on the webinar today and registered will be put in touch with Steve, Michael, and Brian. And so just know that you are welcome to connect with them directly. I think we're going to post this on the Family Office Insights YouTube channel, the recording, so you can share that with others. And then we're also going to be doing a presentation in about a week or so, getting more into the meat of the matter of the venture opportunities here that CNR has. So just keep in mind, if there's anybody that you have in your world or your network, if would benefit from what you hear today, you're most welcome to include them. Also, again, if you have questions, please post them as they come to mind, and we'll get to as many as possible. So with that, Michael, take it away. Thanks for being here, guys.
Yeah, thank you for having us. Everybody who's joining, thank you very much. Like Steve said, we're here in Newport Beach, Southern California. My name is Michael Roll. My partner, Steve Cotton, and Brian Cantwell is joining us virtually. So CNR Capital, just a brief background. Steve and I have been working together for the past 10 to 12 years, different investments, different companies. And we formulated this idea to start CNR Capital. And we're going to get into the depths of it, but I'm going to let Steve introduce himself and then Brian as well, and then we'll circle back around.
Perfect.
Great. Thanks, Mike. Hello. Thanks for all of you joining us today. My name is Steve Cotton, and I've partnered with both Brian and Mike really to help young companies both incubate as well as go to market and then do growth investment, which we'll go over later in the presentation. But I have over 40 years experience both in technology and non-technology companies, startups, public companies, private companies. And as Mike said, we'll get into more about the fund in a minute. Brian?
Thanks, Steve. So I'm Brian Cantwell, and I represent sort of the technology branch of CNR, and I have just shy of 40 years experience in technology, even including technology and investment banking and such. Come from a laundry list of positions, but I've played CTO role in a number and such. And so my main goal is to make sure that technologies are solid. I have a lot of experience in what to do and what not to do, and I think that I just look forward to being able to lend that experience.
Great, thank you, guys. Hey, before we jump in, big shout out to our common friend Steve and I, Jeremy here in Park City, who has connected us, so we're grateful for that. At the risk of embarrassing you a little bit, Steve, could you talk a little bit about your history with Panda?
Yeah, sure. I first met the guys at Panda when I was working for Chemical Venture Partners, and I had a client that wanted to buy Panda Express as part of growing their restaurant chain. And Andrew had, when I went to meet with him, he said, I got a better idea. Why don't you come over and help me build the company? And at the time we had a couple full service restaurants and one QSR. And I think what was interesting about that was over the next, I don't know, 5.5, 6 years, we built 500 restaurants and over, I don't know, 30 different states. And the part that's most interesting to me is that we did that literally without any venture capital. We didn't take any outside investment. And my role there was both, I oversaw all the development of the restaurants as well as it was the chief financial officer. And so it was my job to get the money and it was my job to build them and it was Andrew's job to run them. And he's a hell of an operator, but no, it was a good run. Interestingly, the reason I ended up leaving there was after we built those 500 restaurants, we got an offer from PepsiCo for $750 million, and Andrew turned it down. They wanted it to be the fourth leg of the stool. They had Taco Bell, Pizza Hut, and KFC, and they wanted Panda to be that fourth leg. And Andrew turned it down. I said, dude, I love you, but I got other things to do as well. And I was kind of hoping we'd monetize the investment. And to his credit, I think he probably makes more in a year now from that chain than he would have gotten from PepsiCo. But it was a run. It was good to run. And I'll tell you, the interesting thing is about restaurants, and I think most of you that are probably on this call would agree, it is amazing to me how well restaurants prepare you for business, right? Because you got to understand customers, you got to understand quality product, you got to understand moment of truth. And I always recommend to young people, if you want to learn business, go work in a restaurant for a year and it'll teach you a lot. So anyway, I hope that answers.
Yeah, no, it's super interesting. And I totally appreciate that. Just a quick anecdotal story. My son finished school, moved to New York City and moved in with me. And, he's an artist and he worked at 3 restaurants and it gave him, an appreciation for how dealing with people and not only in the customers, but in the back of the house, the front of the house. And I think it's a skill set that really contributes to your ability to build relationships and that sort of thing. Because you get, the whole spectrum, belligerent people and really nice people, right? How do you deal with that? So super cool. Yeah.
Yeah. It's interesting to pick up on that. When we were building all those restaurants, I probably over that same 5.5 year period, I'll bet you I worked the first day in at least half of those restaurants. That was one of the things that we would do. We'd show up the day it was opening and we'd work the front of the house and the back of the house the entire day. And invariably, as smart as you think you are about how you built that restaurant, you find something that you need to do differently.
Yeah. Just workflow wise or something like that.
Yeah. Where the condiments are, whatever.
Yeah. I'm having trouble. I'm trying to erase the image from my mind of you in an apron, Steve, but
well, I was a much better looking guy back then.
So let's talk about the sort of the abstract, the construct. You guys have been working together 10, 12 years. You raised some money into a fund to deploy capital to things that you understand and know about. I think we noted that, you would be interested in companies that have, I think it's 3 to 500,000, or EBITDA revenue or something like that. Can we talk a little bit about, so what are the, the pillars that you look for?
Yeah, so our large part to this is like Steve mentioned, the incubation of companies. So any company or entrepreneur that comes to us with a great idea, something that we also believe in, then we're going to help them move forward. A lot of these people don't know how to get it set up, legal, get your paperwork set up, get your trademarks, all that. We're going to get you set up with the correct marketing team once you develop your idea. And we're just going to help you from the ground stage. So we want to see the entrepreneur put skin in the game. So obviously they have the idea. We're going to be willing to match them dollar for dollar in the founders round. as we want them to have the vested interest in this as well. So match them a dollar for dollar up to the first $100,000 at the beginning. That way we can get everything in line. So we're going to see the inside outside of how the company is going to work, how we're going to go to market. Brian and all of us are going to help develop the application. So we know everything about it. We know they're not going to be collecting technical debt along the way that might kill them in the later stages. And then once we see all these metrics that we're providing hit, then we're going to go dollar for dollar up to 250,000 at the next round, what we call the friends and family round. Again, matching them so they also have the more skin in the game. And then we're going to help them go to market, go through a beta stage, and then go live.
Yeah, maybe
Go
to,
ahead. Yeah.
maybe to expand on it, let me give you a perfect example. So we had a young individual who had spent 30 plus years in the restaurant industry, came to us and said, hey, I got this great idea of creating some software that monitors the temperature of walk-in freezers and coolers, but I don't know how to do it. So we wrote the application for him, put the whole thing together. He put his money up, we put our money up. He went through a beta. He got 85% of his customers to convert, or beta customers to convert. Okay, all that proves to us is that our product works, right? The beta product works. We did all of that for less than $100,000. Now, by comparison, I was just with the CEO the other day, of which I'm an investor. They haven't even gotten to market yet, and they've spent over $4 million developing their application, okay? And what I said is, I said, wouldn't it be great to have a fund that you go through a product beta, then you go to a go-to-market beta, which this gentleman's in right now that I'm referring to. And that when you went to put your growth capital to work, you've already proven up two things really well for less than $300,000. So instead of writing a $2 or $3 million check, you have assurance that there isn't technical debt. You have assurance that there really is a scalable go-to-market strategy before you go committing significant capital. And that's actually the thesis or the purpose of what CNR Capital is doing. Brian's written many applications. I've spent 20 years as a CEO of technology companies. As Mike said, he and I have invested significantly over the past 10 to 12 years in technology companies. But the one thing I see over and over again, the mistake that I see entrepreneurs making, because they haven't been through this process, they end up over investing. And so when they get to the situation where they need growth capital, you're never really assured, is what you're invested in, does it have technical debt? Is there really a good go-to-market strategy? And so the purpose of this fund is to do just that. It's a scaled approach with experienced entrepreneur investors, Mike, Brian, myself, to ensure that the investment has a better chance of success.
Yeah, it totally makes sense. Would you argue that that could be described as a go-to-market technical debt pilot program, and then you can just flush it if it doesn't work?
Yeah, I mean, look, that's exactly right. I mean, my view is when we did secure temps, like I said, we spent less than 100,000 getting that proven up.
This is refrigeration secure temps, yeah, not
Correct.
temporary service. Got it. Yeah.
Yeah, and so everybody's clear. It's a SaaS operation, and it's software as a service. We know how those are valued, and we knew what the metrics need to look like. And the interesting thing is that we sat down with that entrepreneur and we said, here's what your founder equity is going to look like. Here's what it's going to look like after friends and family. And here's what it's going to look like if you're successful getting a growth round done. Meaning we already worked out the metrics, worked out the ownership, et cetera. And so it's really incumbent upon the entrepreneur. They know that if I meet these milestones, I'm going to be funded. For us as a fund, we know that worst case, if we invest with this person, we may have to write off 350, but that's a lot better than having a
$4 million.
$4 million write-off.
Right.
And then more importantly, we can say to our LPs, our investors with us is that, you know, in that particular example, because we were so efficient with capital, if Marshall, this is the CEO of Secure Temp, sells his company at 45 million, because CNR invested at each stage, we're going to end up with 50% of that against a $2.5 million investment, right? Not a bad way to go. And so what we're trying to do is de-risk at every level before we get overcommitted, if that makes sense.
Totally makes sense. Yeah.
To hammer that home a little bit more, we feel so strongly about that just because with the times right now, how they are in the economy and everybody, you know, being shut out of getting capital, we've been dealing with founders that are looking for capital and everything sounds great, but you're being omitted, you know, however much, 20-30% of the real story. You don't know everything, but with us taking such an early stage approach to these companies, we know everything that's going on. We know what's going well, we know what's not going well. And that way we can help these founders navigate every problem that arises to prove everything, get everything correct, and then grow.
Yeah, not find out about the skeletons later and then have to fix it, right? Yeah.
Exactly.
So let's talk about it since you brought it up. There's, you know, pullback on capital. You know, one would argue that there was lots of free money around, venture-wise, otherwise, debt, you know, banking, the whole thing. What are you finding the sentiment is, and the reality of, you know, pullback on capital allocations, not just on, you know, startups, but growth rounds?
I mean, my personal opinion, and you know, Mike and Brian, you guys may feel differently, but I think what you're seeing, and I've seen this before, you're seeing valuations getting readjusted. You're seeing terms get a little tougher. And the reality is that the length of time it's taking to get funding is being stretched out, right? Because, you know, I would argue that we're in an interesting time, right? Interest rates rising, volatility in the capital markets, although it's been pretty good the last 4 or 5 weeks. But I think that trend's going to continue. And I think the opportunity for us, CNR Capital, is to really look at outside of the incubator. There's, you know, for example, we're working with a company right now in the East Coast, huge idea. Their competitor has gone public, it's got a market cap of a couple billion. And they're at the early stage of their company. They've got a great CEO. It's a huge market, but they're finding it's difficult to get capital. And so, you know, where maybe before they would have, you know, and they've got revenue and they've proven some of it up, but where they may have gotten a 15 million pre-money valuation, now it might be 12 million or 9 million. And I think that's going to go on for some time. That's my personal opinion. I don't know if you feel differently.
Yeah, I completely agree. It's funny how many companies we're dealing with that it seems to be the $12 million valuation mark is just so popular right now. Like within the last 2 weeks, I think we've had
Default to 12, right?
yeah, exactly. So when reality is it's probably a little bit lower, and you know, they were closer to 25, 30 maybe a year ago. So just like everything as of recent, everything's been cut, you know, significantly. So we feel that's a huge opportunity for us. With capital being so hard to get, if you can prove some of these metrics that we want to see, then with a lower valuation now, giving this capital help them grow, put them in the correct places, it's just take off from there.
And then live another day. I mean, let's face it, right? If you have to close the doors because you can't get the next slug of capital, you know, the first step is fire half the people, and then the next step is close your doors if you can't fund your growth.
Yeah, but I mean, for us, one thing that I didn't say, and I think it's important to say, the kind of companies that we're looking for, yes, we're willing to work with them early stage, whatever, but it's got to be a big market. It's got to be a big opportunity. And there has to be a unique differentiator that will help them in the market carve out their space. I mean, honestly, the amount of perishable devices, not just in the restaurant industry, but in all different industries, it's a huge market. we're doing a platform right now. In fact, Brian's in the middle of working with the founders to code it. But we're working on a platform that will bring together influencers, unique content generators, and brands in an exchange. Now, there are other SaaS applications out there that do pieces of what we're going to do, but this is going to be a holistic application that'll allow these guys to basically set up the Shopify of influencers, UGC, and brands doing commerce together. And we went through a process of interviewing agencies, etc. We went through a long process of designing the application. Now it's being coded, but that's a huge market. I mean, right? We don't want to be going after small niche markets. We want to go after something that, whether we sell it or it has the potential to go public, that really isn't as relevant to us. What is relevant is that it has both of those opportunities, not one or the other. If that makes sense.
It's kind of no fun if you're, toiling away with limited, we all have limited bandwidth, right? You can add people and add bandwidth and that sort. But if you're toiling away at something that only can grow so much, it's kind of like, okay, why did we do that, right?
Yeah.
You might not know that. You might not be able to execute on the growth, or at least the potential's there, right? So.
Well, there's that, but the other thing that we explain to entrepreneurs, if it's a SaaS, and you go out and look at any publicly traded SaaS company, and these companies are trading at anywhere from 8 to 12, 14 times revenue. Okay. So I say to entrepreneurs, all you got to do is prove your model up, get to a high growth rate. And one of those public companies could buy you out at 8 times revenue, and it's accretive to them.
Yeah.
And you get a good purchase price. Meaning we're not going to be investing in companies where we have to have it get to 400 or 500 million in order for our LPs to get the return that we want to get them.
Yeah.
This doesn't make sense.
Yeah. Just to be clear to the group here, at the risk of hyperbole, everybody has something they're interested in and want to fund, even if they're just an LP and investor, everybody. So for the group, the objective here is to raise money for CNR. I'm sure you won't mind if you hear from people that have opportunities, but just to be clear to the group, this is a money raising exercise here. So back into the weeds a little bit. If the founder votes with his checkbook, gets aligned with you, puts 100 grand in, you put 100 grand in, do you care whether that 100 grand comes from somebody else that they bring in, or part of it, or the next round, friend and family round? I mean, are you requiring the founder to actually put his hand in his pocket? He might not have any money. That's all I'm saying.
Yeah, no, they may not, but I can tell you, I mean, the Secure Temps example I used, he didn't have money, but what he did is he worked at it, and at the time he was working for Cisco Food Distribution, and he came to me and he said, well, can I pay it out over 4 months, right? Because he really wanted to have his money in. And he did it. I mean, he paid it. We're the other company I was just talking about, same thing. We're like, look, you got to put some skin in the game now. Don't go running to mom and dad to put the money up, or rich uncle or whatever. If you're gonna do that, get somebody that can actually help build the business.
Right, not just money. Yeah.
Otherwise, you're just wasting that equity, in my opinion. I mean, we'll help.
Yeah.
But if that person can help you, whether it's product, markets, design, whatever.
But business development.
Yeah, whatever.
Yeah, that's a big stressor. Some form of operator, that they can help lend their advice, maybe connect you to the right people. So that's part of what we're stressing for how they're raising their capital.
Yeah, totally makes sense. So you've talked a lot about SaaS type stuff. Is that the niche?
Yeah, I think what we want to do, I don't think it's good to go far afield from where your strengths are. And, the common denominator between the 3 partners here is that we all have kind of a technology background, or a technology background that leverages social channels, et cetera. So let's stick to that, right? Let's stick to where we think we have good strengths. I mean, what we're not going to do, and believe me, I love the restaurant industry, but this fund's not going to be investing in restaurants. You know, it's probably one of the toughest businesses I know. We're going to be looking at AI, and we're working on a couple AI projects right now where they're bringing AI into, you know, SaaS applications that have been around for years. I mean, I'll give you an example I just saw the other day where they're starting to bring AI into CRM, right? Makes sense.
Yeah, totally.
You know, now the question for us is, as partners, is can we come up with, you know, a company or a thesis that we believe in and that we could write around that would actually leverage AI into a CRM? Maybe. Could we leverage AI in the application I spoke about earlier? Name of the company is Cure Social, but could we leverage AI there? If we can, we want to do that. We also want to look at renewables, again, using technology, SaaS, but I'll give you an example. Secure Temps. You might look at it and say, well, that's an interesting play, but it's really only a play on monitoring freezers or pharmaceutical refrigerators to make sure you don't have loss of food or loss of pharma. But there's a bigger play here, and we're working on it right now. You probably saw an article a couple of weeks ago where there was a manager that froze to death in an Arby's freezer. So we added another product offering where you could put a panic button, and it goes out of our application, and it goes to everybody on the distribution list, so you know somebody's in there, as an example. But you know where we see the biggest opportunity, and our customers are starting to ask us about it, is the ability to do power cycling of their freezers and their refrigerators when they're beyond the temperature they need to be. Can you take them offline and then bring them back online when the temperature changes? That's a big idea.
It seems like that should have already been thought of, right? And I don't know anything about the business, right?
No, to be honest, it really hasn't. When this whole thing first came to me, I looked at Marshall, you know, because I've known him since he was a little kid. I was like, dude, that's already been done. It's had to have been done.
Yeah, right.
Right? And he goes, no. And so I happen to have some friends in the restaurant business, and I know a few chief nursing officers. Talk to them both, and they're like, no, we do all that manually. And I'm like, wow, that's a big idea then.
Yeah.
And that's what I mean. It's got to be a big idea, and then we got to be able to marry the technology up. It has to be simple. It has to be elegant. The pricing has to be simple. One thing I've learned, simplicity is one of the hardest things in the world to do.
Yeah.
If you get it, it's also makes your momentum and your speed to market a lot faster.
Yeah, you don't have to have a complicated explanation of what your construct is, and people just bail, right? Like it's too complicated, right?
Right.
Yeah. So,
Exactly.
yeah. Have you found that the trend for people to not eat bacon with nitrates and preservatives and, you know, food that has all the crap in it is driven any part of the need for refrigeration and that sort of thing, perishables?
Yeah, I don't know. What I know is that you know, you get into a high-end restaurant and they may be holding on to, you know, in some cases up to $100,000 worth of perishable inventory. So they have a loss. It's a big loss.
It's a big loss, yeah.
Yeah, and you know, particularly if the restaurant happens to be closed on, you know, Monday or Tuesday, which a lot of restaurants are, or a day and a half. But I mean, there's a lot of losses there. I'll tell you where else there's big losses is that they estimate, the industry estimates that 20% of pharmaceuticals in the healthcare industry are lost due to temperature issues with how they're held, which is unbelievable to me. Again, I would have been like you said, that's such a big number. Why wouldn't
It's
you
a
come
big
up?
market.
It
I
is
don't
a
know what percentage of pharmaceuticals need to be at a certain temperature, but that sounds like a huge 20% sounds huge.
Yeah, no, I mean, and I didn't know that. You know, and then you start thinking about, well, what about grocery stores? Well, then, okay, wait a minute. What about wine stores? Okay, well, wait a minute. And, and what we have to do, and this is where what Mike and Brian and I are trying to do, is you have to sit with that entrepreneur and say, you can't chase all of that.
Yeah, right.
You've got to prioritize those go-to-markets. You got to ask yourself this question: who is closest to the customer I want to get to? Build an affiliate program around that,
Yeah.
so that you can scale in an exponential way. We will not, one thing I learned doing this business over the last 20 years, you will not get there by trying to do it through a traditional sales organization that you hire. It will
Yeah.
not work. In my
Too many
humble-
gatekeepers, right? You have to go into the people that already have the customers, right? Yeah.
Yeah, it's complicated, right? And I don't, Mike and Brian and I, at our age, we don't want to do complicated.
Yeah, right. Yeah, right. Well, not only that, I think there's like channel conflict, right? If you start trying to go direct, then then you get boxed out, and there's relationships there, I imagine, that are longstanding. It totally makes sense. And probably whatever you pay to them as an affiliate is probably less than a direct sales force, right? Not to mention,
Infinitely less, you know?
yeah, yeah.
Well,
So,
a good example of that is Fred Lundy built a company called Peregrine. And he almost lost it, sold it to HP for a couple billion. Great story. Turned around and started another company with JMI Capital down in San Diego, a company called ServiceNow.
Yeah.
Okay. And I
look
don't
at that company, right?
I don't think I need to say anymore. I mean,
Yeah,
they
right.
got huge valuation, right?
Yeah,
But you know what? You know how they grew that company? They grew it through integrators.
yeah, yeah. Yeah, I think there's a lot of merit in not trying to solve all the problems. Like, get the Trojan horse in there, right? Get the customer, and then, add the things that need to be added that can be scaled, right? That you guys know better. Yeah.
Right, to kind of add on our approach, so we're kind of giving the more hands-on approach. So we're doing weekly meetings with these entrepreneurs. Many times it's more than once a week. We're always available via phone, but the weekly meeting is where we're setting, steps, the one step in a row, just to kind of climb the yellow brick road and get to the end goal. So using Secure Temps, for example, Marshall came to Steve back in December of 22, and I think we launched beta in March.
Yeah.
All the way through June, and we went live July 1.
No, June 1.
June 1, excuse me. And so with these weekly meetings, we're putting in our marketing team, we're developing our go-to-market strategy, working on everything that needs to help the entrepreneur go step by step and not just be overwhelmed with all these tasks. And like he mentioned, simplicity is the key for us. So we want to keep them focused and just kind of provide these breadcrumbs to keep them along the trail to get to go to market and live.
Yeah. It's, I think part of the benefit of an entrepreneur that he gets easily distracted, and part of the risk, right? So to keep people, Charlie Rose interview with Bill Gates and Warren Buffett, independent of the whole Charlie Rose mess, he asked them, what's one, if you could have one word that's the most important in business success, and they both said the same thing: focus. So if you get distracted, it's like, it's easy to get distracted. Yeah.
Well,
yeah.
Yeah, no, look, I think that's right. And I think the other thing I think that's important is learning to make mistakes quick and learn from them. And I think oftentimes entrepreneurs, and I know I certainly was in that place when I was younger, is you tend to want to not make mistakes. You're defensive about it, you're whatever. And what I always try to coach young entrepreneurs on is make the mistake quickly, because the mistake is going to help you quickly pivot to get to where you need to go.
Yeah,
And
let's not do that, right? Yeah.
Yeah. But to give you an example, we're figuring out our go-to-market on Secure Temps, and we absolutely were certain that we had the strategy on how to go to market. And it was, we were going to go through a manufacturer's rep to the restaurants, to the chefs that are in the back of the house where the walk-in freezer and cooler is. Turns out that doesn't work.
Yeah,
It turns out that what you really got to do is get to the owner. So then, we have to ask ourselves a different question, back to what we said before. Who is closest to the person we want to get to?
Yeah.
So then you start asking, well, then, okay, if it's not that, is it maybe a service guy for the True Freezers, which is the largest manufacturer in the world? Is it that group that we need to go after? But you want to get to that place as fast, and we figured that out 3 weeks into going live, right? I don't want to find that out a year from now.
yeah. We spent all this money in business development and we were talking to the person that couldn't make the decision.
That makes
It
sense.
didn't see the benefit, so couldn't make the decision, right?
Yeah. And so where we want to make CNR a little bit different than the other funds out there is everybody sitting here, we've actually made investments, run companies, borrowed money from the bank, issued public stock, did a certificate of determination on preferred as an issuer, not just as an investor.
Yeah.
And we want to bring that experience to the benefit of both our investors, but also the entrepreneur.
Yeah.
And I think that's something that's unique from my point of view.
Yeah, it'll take 2 failures and 1 success for them to learn all that, right?
Yeah. Good point.
Yeah. So what's a profile of a good investor for you? LP.
Yeah, that's a good question. Well, it's definitely somebody that feels comfortable around technology, because that really is the thesis of this. So that's number one. Number two, it's somebody that recognizes that Mike and Brian and I are always going to just call it the way we see it. So, there might be one day we call you up and say, look, we don't think we're approaching this right, so we're going to pivot this way or that way. If somebody's not comfortable with that, that probably wouldn't be or we wouldn't be a suitable investment. And look, at the end of the day, we're looking for someone that can make a capital commit, because you don't have to invest up front, but a capital commit.
Like a drawdown.
Yeah, right. In other words, we're only going to make the capital call when we have a suitable investment.
Yeah.
And probably the other is that it's somebody that recognizes that it's a legged in investment, not just from a capital call down, but one of the things Mike and I felt very strongly about is we didn't want there to be a conflict with us investing at the seed round, the friends and family round. And instead, what we would do is have the fund do that so that everybody benefits from it.
Yeah, so now
Rather
you're
than-
picking and choosing the likely winners against in conflict to the LP investors in the fund. Got it.
Yeah, and we didn't want to do that.
Yeah.
So I mean, I think that's really it. And then, look, I think the other thing is an investor that's got some insight and buys into what we're doing and feels like, they could pick up the phone and call one of us and say, hey, have you thought about this? We would welcome that. Because nobody's got a monopoly on, what the best idea is.
Yeah. How do you feel about the VC stats? So, a lot of VCs pull the money in and they're itching to deploy it because they have to put numbers up on the board, and then they throw them. This is my editorial. I'm not saying you feel this way. So just to be clear. And then they, throw as much money as they can against some of the things they think will be winners, and then flush the rest, not giving them a chance to necessarily, and then maybe they should be flush, but the stats are pretty tough with VCs. 70% or better just gets flushed. How do you feel about that, and what do you think you can do about it?
Well, I think that's partly why our thesis is set up the way it is. So we're going to match them, the early stage up to $100,000, then the next round up to $250,000. And then the maximum check size that we're going to give is 10% of the fund. So $2.5 million. A lot of that is, if you're just going to throw it away, like you're saying in this example, it's going to be a minimal amount compared to every dollar that we're investing in total. So we don't see it as that. We're not just throwing money, kind of spray and pray type of thing. If one makes it a unicorn status, then that's going to be the returns for everything in the fund, but we're hoping to be much more efficient just by going that route.
Yeah, I agree with what Mike said. I think the other thing is that, look, we want to be as efficient with capital as we can be. And I think the reason the stats are so poor, like I've worked for VC-backed companies and I worked for a VC company, and then I've worked in companies as an operator that had VCs. And I'll give you an example. I mean, a lot of times these VCs come up with some really crazy ideas about how management ought to operate. I was doing a roll-up in the collision center business with Chemical Ventures and Donaldson, Lufkin, Jenrette, and I was the president and COO. I turned the company around and fixed it. And Chemical Venture Partners comes in and says to me, yeah, but we really want a 55-year-old guy to be the president, and we want you to move aside. So I'm no dummy. I finally got tired of fighting with Chemical Venture Partners. I said, you know what? Buy my investment out in the C round and I'll go away quietly. I did that. 7 years later, that company was bankrupt.
Yeah.
You can't do this stuff on optics. It's about being a tough, hard operator. And it means calling bullshit when something's not working right. And I think a lot of times VCs are like, well, we'll bring in a consulting firm, or we'll bring in this, or we'll bring in that. I don't want to pay for that as an investor. I'm not interested.
Yeah.
If I'm going to back somebody who's going to invest my money, I want to know that they could actually step in and run that company if they had
If
to.
need be, yeah.
Yeah. And you know what? I can run a company. I've done it not my whole life, but I've been a CEO for the last 20 years. So if something happened to Secure Temps or Marshall, something happened to him, I can step in tomorrow if I need to.
Yeah.
So I just think it's set up differently, and I get it. I get the reasons for it, but it's not what Mike and Brian and I are about. We certainly recognize that something can go wrong on one of the investments, but I'll tell you what, my belief is it's going to be flipped. I think it's going to be 70-30 flushed. Of the 70, I think 2 to 3 are going to do really well. And then I think the other 2 or 3 are going to not only get us our capital back, but get us our preference return. And that to me is a good day.
Yeah, it's a win. So
Yeah.
Let's reconcile those numbers. So $25 million fund, 5 to 7 years. How many companies?
I think we'll end up doing between 8 to 10 companies.
Yeah, fair enough. Yeah.
Because
You need to have the drawdown for the next rounds, right?
Yeah, but I mean, candidly, Mike's right. Our charter is that we really don't want to do more than 2.5 million in a single investment. That being said, if we thought that there was a real compelling reason for us to go a little bit more, we would go back to the LPs, have the discussion with them. We could look at doing that. But the reality is, if they need 5 million or 10 million, the better way for us to do it is to bring in another VC to help out. And frankly, if they want to do a much higher pre-money valuation and let our LPs get their basis and their preferred return out and then ride the rest, which I've done before,
Yeah.
then that's what we're going to do.
Yeah. I totally get it. It totally makes sense.
Yeah.
So this has been super helpful and great. Thank you for doing this. And just we're gonna target a date in the next 10 days or so to do a formal pitch and that sort of thing. But this has been very clarifying and super appreciate it. So you guys have some closing remarks and then we'll wrap it up.
I mean, that was pretty straightforward. That's what we're about. Operators willing to do everything, meet weekly. We stated our guidelines for the capital calls. Hope you guys enjoyed it. I know it's our background, it's our passion, so we're a very hands-on approach, and this is what we love to do.
Yeah, awesome. Well, thanks for being here, Brian. Thank you for being here. Good to see you guys. We'll get the recording out. We'll alert the group on the next date, and then we'll just keep on moving. Thanks for doing this.
Yeah. Thank you everyone for your time. Really enjoyed it.
Yep. And as I always say, thank you all for being here and sharing with us the only thing you can't make more of, and that's your time. Thank you. Till next time. Thanks, guys.
See
Cheers.
ya.